Welcome to RBC's Markets in Motion podcast, recorded March 3rd, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we review our basic framework for thinking about drawdowns in U.S. equities, a topic that's been coming up in client meetings over the last few weeks. Second, we've refreshed the math behind our year-end 2025 bear case of 57.75, specifically our valuation and earnings stress test. Third, we run through our latest update on the vibes breakdown in the U.S. And fourth, some of our work suggests opportunity is opening up in small caps, though we think it's too early to go overweight. If you'd like to hear more, here's another 5 minutes. We'll start with takeaway number 1, our framework for thinking about downside risks to U.S. equities. For many investors we've been speaking with, uncertainty and anxiety have increased in recent weeks. The disruption in Washington, health of the consumer, and the labor market have all been in focus, with lower 10-year yields and renewed discussions about cuts from the Fed later this year providing some comfort. For many weeks, most U.S. investors we've spoken with have assumed tariffs would be a negotiating tool rather than a long-lasting reality. But in last week's meeting, several investors expressed to us their worry that this idea was just too consensus. Some investors from completely different corners of the equity market with completely different investment styles have asked us a similar question. How do we think about potential downside risks to the equity market? Some have simply been thinking about where a put might be in the short term, and others have been exploring how U.S. equities respond generally to big uncertainties. Here's what we've been saying about the 4 tiers of fear, as we've started to call them. Tier 1 are garden variety pullbacks. These are drawdowns of 5 to 10% from peak. Since 2022, the U.S. equity market has experienced a handful of these. The worst came in the fall of 2023 as 10-year Treasury yields surged and the S&P 500 fell 10.3%. Net bullishness more than one standard deviation above the long-term average on the weekly AAII investor survey has helped to identify their onset, a milestone last achieved in October 2024, which has kept us on guard for one of these drawdowns. From the recent peak, this kind of decline takes the index to the 5,500, 5,800 range, and we see the low end of that range as the first battleground where the U.S. equity market could display some resilience. We think our year-end S&P 500 price target of 6,600 could absorb a pullback in this range, but if a drawdown of more than 10% occurs, our 6,600 target is unrealistic. Tier 2 are growth scares, and these are drawdowns of 14 to 20% from peak. Investor confidence in the aftermath of the great financial crisis was extremely low for an extended period of time. And from 2010 to 2018, there were 4 of these: the European debt crisis, the U.S. debt downgrade, the industrial downturn of 2015-2016, when consumer resiliency helped the U.S. avert an outright recession, and 2018, when the China trade war and Fed fears took the S&P down almost 20%. What these all had in common was that investors suddenly became very fearful that a systemic issue or recession was unfolding, but ultimately these failed to materialize. The risk of this kind of drawdown has moved up recently in our view. Tier 3 are recessions and wars. These are roughly 25 to 33% drawdowns from peak. When growth fears turn out to be legitimate, the S&P 500 tends to lose around a quarter to a third of its value, and war-related drawdowns in recent decades have been similar. Tier 4 are major modern crises, with drawdowns of roughly 50%, give or take. We started our career in the early days of one of these, the tech bubble unwind of the early 2000s. That drawdown totaled 49% through the October 2002 low. The great financial crisis drop was worse, with a 57% peak to trough decline. It was the GFC that helped us develop the list of things we use to look for bottoms in any tier of U.S. equity market fear. Sentiment surveys like AAII, moves 1 and 2 standard deviations below the long-term average, tend to be buy signals. Earnings revision trends, we look for improving rates of change off trough levels, and small cap PEs are some of our go-to ones. Since the 1990s, the Russell 2000 forward PE usually bottoms in the 11 to 13 times range in a major economic tribulation period or slightly below average. Moving on to takeaway number 2, refreshing the math that goes into our bear case for the market. Back in November 2024, when we issued our year-end 2025 price target of 6,600, we also mapped out a potential bear case for the S&P 500, which had a year-end level of 5,775. While we haven't made any changes to that ultimate 5,775 bear case at the end of the year, we have revised our stress test on one of the models that goes into the bear case that's worth a mention. Specifically, this is our valuation and earnings stress test, which is now baking in flat earnings in 2025 relative to 2024. This is similar to the lack of movement in the annual numbers on earnings from 2014 to 2016 around the industrial recession. Previously in our stress test, we were using our base case earnings forecast of 271. The other thing that's changed in our stress test is that we're now using a different inflation and interest rate scenario. Now we have sticky inflation at 2.5% on PCE baked in, along with several Fed cuts and 10-year yields at 3.5%. Whereas before, our stress test here was baking in higher inflation, Fed hikes, and 10-year yields at 5%. Both the old and new valuation and earnings stress tests point to a fair value for the S&P 500 at year-end slightly above 5,600. The improvement in the multiple in the new stress test is offset by the EPS degradation that we assumed a growth scare might lead to. Next up, takeaway number 3, a quick update on the vibes. Strong post-election vibes were an important part of the bullish consensus on 2025 for U.S. equities, which has come under sudden pressure. The various categories of vibes we've been monitoring have generally been weakening, or in the case of corporate vibes, have been dented by policy uncertainty. Here are some of the latest developments. Investor vibes have continued to weaken and are back to crisis lows on some metrics. Bears in the weekly AAII survey, a weekly gauge of investor sentiment on the individual side, surged to more than 60% last week, on par with levels seen in September 2022 and a little shy of the 70% level in place in March 2009 as equity markets hit their GFC lows. October 1990, which was 67%, a recession year, and February 2003 at 58%, the end of a multi-year period of recession, war, and extreme angst, were other periods that saw extreme bears in this range. With last week's move on the survey, net bullishness fell to minus 41.5%, taking the 4-week average down to minus 20.3%. The 4-week average is now nearly 2 standard deviations below the long-term average, a level last seen in October of 2022. We also got more evidence of weakening consumer vibes last week. Consumer confidence fell and missed expectations in the Conference Board survey and is now near the low end of its post-COVID range. The most interesting thing to us, though, was that consumers' expectations of where the job market is headed has deteriorated, echoing what we saw in the prior week's CEO confidence survey. These releases have struck a nerve with some of the equity investors we've spoken to recently. Several mentioned noticing more layoff announcements by public companies, something, frankly, we've also noticed in our own reading. Wrapping up with takeaway number 4 on small caps. Small caps have gotten hit hard recently in terms of performance as economic growth fears have escalated. On performance, the ratio of the Russell 2000 relative to the S&P 500 is essentially back to its 2024 low. Meanwhile, the Russell 2000 forward PE has fallen to just above 15 times and slightly below its long-term average. This latter data point on valuation is particularly interesting to us because small cap PEs often bottomed out slightly below average from 2015 to 2019. We've been neutral small cap relative to large cap and think it's premature to turn overweight. We'd like to see CFTC positioning and U.S. equity futures for the Russell 2000 get hit harder before believing the froth is completely out of this corner of the equity market. And we think we are still in the early days of ratcheting down economic expectations. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.